Hello, everybody. Welcome. My name is Bennett Tchaikovsky, the accounting professor. I'm going to walk through, at the request of a viewer, I'm going to go ahead and walk through exercise 15.8 or exercise 14.8. They're both exactly the same. It's 15.8 in the 17th edition, and then it's 14.8 in the 18th edition. Textbook authors are Don Kieso, Jerry Weygandt, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved for this for educational purposes only. Video may not be distributed or redistributed without the express permission of Wiley. My solution presentation is copyright. Oh my goodness, we're in 2024. That's how long it's been since I've done one of these videos. It's crazy. It's by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself and not the authors of the textbook or of Wiley. Okay. So let's take a look at this. So correcting entries for equity transactions. Okay, so Piston Zinc sounds like a winning basketball team. I don't know if they are doing any well or not. Recently hired a new accountant with extensive experience in accounting for partnerships. Because of the pressure of the new job, the accountant was unable to review what he had learned earlier about corporation accounting. During the first month, he made the following entries for the corporation's capital stock, right? So let's go ahead and look at this one. So cash and capital stock. So May 2nd. So the first issue is with 5.2 is that when we're going through, we're asked to prepare the new entries essentially for this. When we're dealing with owner's equity, par value represents the minimum amount that a corporation has, or basically, and I kind of let me go through and explain this. So let's go ahead and take a look at meta. Okay, so what exactly is par value? Well, when a corporation goes through and basically, issues stock, you're going to see that they go through and issue, you have to have a par value per share. Typically, this is set as a fraction of a penny. Why is it set so low? Because when a shareholder buys a share of stock from a company, they do not have, if the company is sued or goes bankrupt, there is no liability for that shareholder, right? That you're going to lose your investment. However, if a shareholder purchases stock for below par value, there creates a liability for that shareholder when, if they're purchasing it from the corporation, they owe a minimum up to that par value. So it's a minimum investment required. So what you will see is 0.0006 par value, right? That's what this is. And so when I see $5 par value, and it's not Berkshire Hathaway, it's a problem, right? And this drives me bananas. I think I wrote it to the guy from Kieso, and they said they would change it for the 19th edition, but we'll see what they do. In any event, when we issue stock, we can't just say capital stock. We have to say common stock at par, and then we're going to call something called additional paid-in capital common stock, which is what you'll see over here for the excess beyond the par value. So when we look over here, we're receiving cash. So over here, this is going to be 12,000 shares at 16 or 192,000, right? So that's where that 192 came from. So I'm going to be crediting common stock at par. When I credit common stock at par, this is going to be $5 par value per share times 12,000, right? So my $5 par value times 12,000 shares. The additional amount is going to get dumped into additional paid-in capital common stock, or in this case here, it's whatever I need to do to go through and to balance the journal entry. And the thing I'm going to end up over here with saying is to record issuance of common stock. So that's what I go through and do over here on May 2nd. That's it. So you can't, when you're issuing stock for a corporation, this is what you have to go through and do. Let's take a look at the next one. So the next one over here is going to be, I issued 10,000 shares of $30 par value preferred stock at $60 per share. So one of the things I'm also going to use this as a lesson for publicly traded companies when they issue preferred stock, the Securities and Exchange Commission, what they will go through and require the corporation to do is to basically make sure is that when we go through and we're going through and issuing we're going through and doing a share issuance, they're going to go through and require all the preferred stock to essentially be wiped out. And I want to go back perhaps a little bit earlier, and we'll view all 10Ks to go to an earlier K of Snap. So we all know what Snap is. This is Snapchat. And if I look over here, what you'll go through and see on their shareholders' equity is that you'll see all of this preferred stock. When a corporation is private, meaning that they're not public yet, it's okay for them to have preferred stock. However, the Securities and Exchange Commission, once a company becomes public, they're going to want to see that go away. Now, you can have, as we kind of see over here, different types of common stock. You can have Class A and Class B, and this is why Mark Zuckerberg will never be voted out of office, because he owns the majority of the higher powered shares. I can't remember what it is at the moment, but you can have different classes of stock that have different voting rights. But generally, when it comes to preferred stock, if you are a publicly traded company, we're going to go ahead and get rid of it. It's got to be converted. So when I come over here to look at my next particular entry, and we'll do this on 5/10, I'm receiving cash, and this is going to be 10,000 shares times 30, or sorry, this is going to be, I sold 30, I messed up, 10,000 shares at $60 per share. So that's the amount of cash that I receive. I'm going to have preferred stock par. My preferred stock par is going to be 30 times 10,000 or 300,000. And then I'm going to have additional paid-in capital preferred stock. And this is going to be the difference, or over here, of 300,000. And this will be to record issuance of preferred stock. Okay. So that's what we should have done on May 10th. And let's go to the next one over here. So next one over here is going to be on the 15th. So on 5/15, I purchase 1,000 shares of my own common stock for the Treasury at $15 per share. And the cash part is right? Because when I come over here and when I'm paying cash to repurchase my own shares, this is going to be 1,000 times 15 or 15,000. Okay, this is very common in companies to go through and do this. I think they'd be better off paying dividends, but what do I know? They like buying back their own stock. So I'm going to look at my friends over here at the Home Depot. Let's see if we'll come up. There we go. So when we go over here and we look at the Home Depot, go to the balance sheet, and what you see over here is Treasury stock. So Treasury stock functions. It is not a contra equity account. Rather, it's going to have a debit balance, and it's going to reduce our owner's equity. We're basically returning shares to the Treasury that have been previously issued. So we don't call it capital stock because these are shares that we're purchasing that have been previously issued. So what I'm going to be going through and doing is I'm going to be debiting Treasury stock, or TS, for 15,000. And here I'm going to say to record purchase of Treasury stock. So that's what I'm doing on the 15th. There we go. Exciting. Now, coming down over here, gain on sale of stock, sold 500 shares of Treasury stock at 17 per share. Very important thing. Whenever we are dealing with the sale of our own stock, meaning if I've issued shares and we never recognize a gain or a loss. Why is that? It is because it looks like manipulation. We never recognize gain or a loss on the sale of our own shares of stock. So when I come over here to 531, I sold Treasury stock. Now, if I were to give this on an exam, I would say I basically, okay, I don't even know where they're coming up with these numbers. So coming over here, gain on sale of stock, sold 500 shares of Treasury stock at 17 per share. So coming over here, what I'm going to be going through and doing is I'm going to debit cash 500 times 17, or that's where they're getting their 8,500 from. When it comes to what I'm going to go through and credit is I'm going to go ahead and credit the Treasury stock essentially for the amount of what I paid for the stock. Right now, here's what I don't know. Does it relate to the previous transaction? I have no idea. I'm going to assume it doesn't, and I'll go through and use what they were going through and showing. So for this one here, right, I'll keep their 5,000, right? I'm just using this. If I were to use the purchase price on the 15th, this would be 500 times 15, right? But it looks like they're doing something else. I don't know what they're doing. So coming back over here, we'll go ahead and use our example. Now, we don't recognize gains, but over here, additional paid-in capital Treasury stock is what happens when we sell our shares of stock back for more than what when we sell our Treasury stock for more than what our cost basis is. So that's how we go through and handle these transactions. I hope you found this video to be informative and helpful. And if you did find it like that, please remember to give a like and subscribe. If you want to thank Wiley for allowing me to go through and use your questions, I look forward to seeing you on the next video. Have a great day.